Hello and welcome to Money, Me and COVID-19, where we meet with leaders from the world of business, finance, investing and politics to understand the full impact of this pandemic and how we can position ourselves to survive and hopefully thrive as we come out the other end of it. My guest today is one of the best known and most successful fund managers of modern times. He's known as the Indiana Jones of emerging markets, and for 25 years he ran Templeton Emerging Markets and built it up to over $40 billion under management. He was voted one of the top 10 money managers of the 20th century, and in this century he's been voted one of the 50 most influential people in the world. He was asked to join the World Bank's Global Forum on Corporate Governance. And he's long had an interest in ESG, ethical investing, and that's all covered in his latest book, Investing for Good. He is, of course, Dr. Mark Mobius. Mark, welcome to Money and Me.
Thank you. It's a pleasure being with you. Thank you for that nice introduction.
Well, it's just great to have you with us today. And if we could start perhaps with some definitions, because not everyone's familiar with terms like frontier market and emerging market. How would you characterize a frontier market and what has to change for that to become an emerging market?
That's an interesting question, and it's a question that is difficult to answer because there are changes being made. The number of countries being added and subtracted from various indices is constantly going on. But to start at the beginning, when we started the very first Emerging Markets Fund in 1987, the World Bank had a definition of low, medium, and high income countries. And we took all the low and medium income on a per capita basis as the emerging countries. And that included all of Latin America, all of Africa, all of Asia, except Japan, Australia, New Zealand. Eastern Europe, of course, was not there at the time, but when the Iron Curtain came down, then Eastern Europe was added. And then later, I'd say about 15 years later, people started thinking, well, shouldn't we separate these smaller markets, markets that are very, very small and illiquid, and call them frontier markets? And that's what happened. And you see the list includes a number of countries in Africa and in Vietnam. Actually, Vietnam has been included as a frontier market, but I think they'll soon probably be graduating into the emerging markets list. So I would say that frontier is really a subset of the emerging markets group.
Okay, and when you think of some of these countries, to be fair, you tend to think about volatile currencies, you think about regime change, corporate governance issues. What are the criteria that you think would make a country investable versus those that perhaps remain as no-go areas?
Well, the key as regards to investability is liquidity. In other words, and by the way, one of the definitions of a frontier market is one that is relatively illiquid. In other words, let's say most of the shares are having a daily turnover of well below $1 million a day. And also, if you look at the foreign exchange restrictions that you have around the world, that would be another problem that you face when you're investing in these countries. If a currency is restricted, then it's very difficult because you can put your money in, but you may not be able to get it out. So I would say those two criteria, liquidity and currency exchange capability, those are the two important criteria.
Okay, so given that, which are the countries that feature most in your current portfolio, and which ones do you expect to be adding to it in the years ahead?
In the current portfolio, we include, we have stocks in Korea, Taiwan, China, South Africa, Turkey, Poland, Brazil, and Vietnam. So those are the countries in which we're invested. So you can see it's a pretty big mixture of different, and India, I'm sorry, I forgot to mention India, of course, should be included. In fact, the two largest countries in the portfolio are China and India.
And you still regard China as an emerging economy?
Oh yes, definitely. Very good point, because if you took China out of, let's say, any of the emerging market indices like the MSCI indice, you'd lose 20, 30% of the index because China is so big and getting bigger. But it's a very relevant question because people are beginning to think, well, wait a minute, China is beginning to dominate the indices. So you don't have to worry about what the other countries are doing. If you look at the index, you're following China. But India is coming up, and I think some of these other countries will grow a little faster, so they'll balance it out.
So if I introduce a new rule that said you're only allowed to bring 2 new countries into the portfolio during the 2020s, which would those countries be and why?
I would say we'd have to look at those countries that are, shall we say, bombed out. You know, the ones that have come down the furthest and have not yet recovered. So I might want to include a country like Nigeria, which is one of the more difficult places in which to invest. Oh, by the way, I forgot to mention Kenya. We also invested in Kenya. We might want to do more. Generally speaking, I would look at African countries because those are the countries that have the most difficulty and probably companies that are most down in price. But there are many opportunities in many, many countries around the world. In the past, we were investing in Argentina, in Chile, in Peru, in Colombia. All of those countries are susceptible to being looked at for investment bargains. And then in Asia, of course, there's Indonesia, Malaysia, Singapore, Thailand. So many, many opportunities around the world.
But interesting, you talk about the expression, bombed out. I mean, the West has really struggled as a result of the measures taken around COVID-19. I would imagine for many of these smaller countries that are in your kind of purview, the impact has been even greater. And what are you hearing from people on the ground about the full economic impacts of the pandemic?
Well, that's a very interesting point because if you look at the indices, the stock market indices of these countries, you can take the MSCI, South Africa MSCI, Thailand, et cetera, and other indices, you'll see that many of these markets have come up more than the recovery that we've seen in the US. So the recovery has been quite dramatic in all of these countries. I can't think of any country that has not come up at least 20% from the bottom. Now, of course, many of them fell more. You had 50, 60% decline in some of these markets. But as regards to the stock market indices, the recovery has been dramatic. Now, if you believe, as I do, that the market, the equity market, is a leading indicator for the economies, then you've got to believe that the economies of these countries are going to recover as well, pretty fast. So now what's happened with this COVID shutdown, it's been very, very damaging to many of these countries. For example, I was in South Africa a month and a half ago. I was there for 2 months, locked down in Durban and then Cape Town. And there, going into the crisis, there was 30% unemployment. Can you imagine what the employment level was once they locked down, which they did very strictly? So once you come out of this incredible lockdown, strict lockdown, the recovery can be very rapid. And that's what we're going to be seeing in South Africa, I believe.
So do you see, weirdly perhaps, that this is actually a buying opportunity because those countries which have got a combination of having been bombed out by the pandemic, but also having the most potential, is this actually a good time to be getting in?
Exactly, and which is what we've been doing for the last 3-4 months, because there have been tremendous opportunities to come up. Now, the problem is that the market has come up very fast, so you've got to be careful that you don't, put everything in at once. And when you have a recovery from the bear market like we've seen, there's always this, what I call the climbing the wall of worry. Because as the market is recovering, there's constantly bombardment of bad news. There's a second wave coming. more people have died at this place, or so forth and so on. But the market keeps on recovering and then falls back maybe 10, 15%, then moves up again. So this is what you got to be aware of and take the opportunity when these corrections come about. You can go in and buy.
Okay, because it's interesting, we're kind of talking at the macro country level, but your approach is very much down at the micro individual company level, where you take a very activist approach and you actually get involved helping with measures like ESG. Tell me typically how you would engage with a company and what your team would actually do.
Yes, you know, ESG now is the name of the game, environmental, social, governance matters. And what we feel is that governance is the most important. So when we go to a company, once we look at the financials and they look good, and we think there's a good growth prospect and a good earnings potential, we then go to the company and ask them, what are you doing about governance? Do you have independent board members? How is the situation with your treatment of workers? What is the management like? All of these factors that impinge on governance is what we look at. And we then also engage with the companies insofar as asking them, are you willing to have a discussion with us on how to improve your governance? Because studies show that if you have good corporate governance, your stock price will improve. So we enter into that kind of discussion. If the company is not interested, then we will not buy the stock. And we found that there's pretty good reception among companies. Even if we are a small shareholder, we can still be heard, and people are interested in this kind of engagement.
That's interesting. I know you're talking to us from Munich today, but you spend a lot of time in Singapore. And a couple of years ago, I interviewed Jim Rogers in Singapore.
Oh, yeah.
And of course, he'd done his 2 famous world tours visiting these countries. And I think you also have that kind of part of your playbook. You like to actually go and see the company in the country as part of your research.
That's right. I'm constantly traveling, and now being locked down, I feel very uncomfortable because I really want to get out and visit the companies, visit the countries. In fact, before COVID, I was in Latin America and was in Brazil, Argentina, Chile, and a few other countries. And then I flew to South Africa. And all of that was about visiting companies.
Okay, but I think one of the things that I wonder about is that passive investors have had a great decade. They kind of followed a bull market all the way up without really getting that close to any individual countries or companies. I wonder if we look at the next decade, whether that approach could still succeed, or whether it's more likely that being targeted with a very concentrated portfolio on certain countries and companies will actually produce a better return. What's your take on that kind of passive versus active argument?
Yeah, the excellent question, because as you know, the industry has changed dramatically. The industry has moved from active to passive. In other words, all kinds of passive funds have been launched. In fact, if you look at the flows of funds going into mutual funds, most of it has gone into passive funds. Now there's a growing awareness that maybe too much has gone into these ESG funds, and now we have to be more active. In other words, you can go into an ESG indexed fund, but it doesn't really have the impact of an active manager going to the company like we do, and trying to make change, trying to create change. So what we're going to do going forward, I believe, is see more and more active funds being launched. Of course, the passive will continue to be very, very big and will also grow. Of course, in total, the amount of money going into mutual funds is increasing anyway, but there's going to be a growing awareness of active managers and also private equity. It's interesting that in the US, the Labor Department, which regulates where money goes into pension funds, is now considering to allow individuals to invest in private equity funds, which would be the first time this has been allowed. So I think there's a growing awareness of the need for this kind of active management in fund management.
Yeah, and I think part of that is, and I don't know if this is the thinking there, but a lot of value, a lot of wealth is now being built away from the stock markets in companies that are held privately, and people are not necessarily able to access it unless they're kind of private equity insiders. So is there a role, do you think, for whether it's companies like yours or for the authorities to somehow make the average investor, give them access to that kind of wealth creation going on off market?
Exactly. That's precisely what the U.S. authorities are looking at, because they realize that pension fund holders have been missing out on a lot of this. Of course, pension funds themselves have been investing in private equity, but individual pension fund managers, people that are managing their own pension, should have the opportunity as well. So that you see, you're going from defined benefit to defined contribution. In other words, more and more people in the defined contribution segment will have to make their own decisions regarding where they're going to put their money, because the only pension they're going to get is what they've contributed. Whereas, as you know, defined benefit means you're going to get the money regardless, and it's managed by some faceless pension fund that you don't have any participation in.
Oh, absolutely. I mean, this is one of my biggest hobby horses now, and most of the people watching us are people who have taken that conscious decision to take ownership of their financial future. They're business owners, entrepreneurs, and property investors and high net worth individuals. But, and this brings me on to my other hobby horse, if you look at what the Federal Reserve is now doing in America, not just the scale of their money printing, but the fact they've gone beyond government bonds into corporate bonds, and even giving people like BlackRock taxpayer money to buy their own ETFs. I mean, this is such crony capitalism and market manipulation. How can we poor investors know what to do?
Exactly. Well, they're following the path of Japan. As you know, in Japan, the central bank has been buying actually equities. They've been buying ETFs. And that's where a lot of money is going in globally, but in Japan as well. So ETFs are the big passive fund category that is growing at a very fast pace.
But as a corporate governance expert, what are your thoughts on the way central banks are involving themselves in these markets? Because it does, things like price discovery become almost impossible from an economic perspective. So how do I know the fair value of an asset when that ETF's got gazillions of taxpayer money through BlackRock, and this one hasn't, even though it might have better underlying assets within it?
Oh, absolutely, it's an abomination. I think this whole thing of central banks getting involved in this sort of thing is just incredible. I think it's not a very good pattern that we're seeing. Of course, but any action like that has a reaction and an opportunity, because if everybody's moving to ETFs, passive ETFs, even if it's an ESG ETF, there may be opportunity on the other side for someone like us who goes in and looks at individual companies and not buys what everybody else is buying, which is basically what an ETF is. It's the mass market, and it's what the market capitalization of the different companies are, which go into an index, which in turn forms the ETFs.
Yeah, indeed. So I guess the opportunity that you're exploiting is that not just that you're going to select certain countries and companies, but if I can quote from your own website, activism is not a shareholder privilege; it is a right and an obligation. When we invest in a company, we own part of that company. Ownership means responsibility. So you're not just, even most active fund managers would simply choose the stocks to buy. They wouldn't get on an aeroplane and go and see the board of directors. So I suspect your point of difference here primarily is that active engagement, where you're actually adding value to the thing, you're forcing value into the company you've now invested in.
Exactly, that's precisely the approach. And of course, if you're in an ETF, that's not going to happen. It's just going to be a passive investment in an index. So that's precisely what we're trying to do, is affect some change. And by the way, it doesn't have to be an aggressive approach. The idea is to cooperate with the company to help improve the company so that the value will be created for everybody, including the company itself.
Yeah, and I mean, you were focused on ESG long before it became fashionable. And do you think that in a funny way, COVID-19 is actually going to act as a trigger to put that much higher up the agenda?
Oh yeah, I think this COVID situation has created a lot of awareness globally of the problems in not only healthcare, but problems in government capabilities, government ability to challenge, take the challenge for many of the things that are happening and correct them. So the awareness of governance generally is now much more salient. And that includes not only governance in government, but governance in companies, which is why you see more and more companies coming out with new policies to address social issues. And that's very, very good, I think.
No, absolutely. And it seems like from the data that you've quoted that you can actually improve the company, improve its value and its share price by doing the right thing. It used to be seen as kind of an overhead and a cost and a kind of an obligation, but I think you're seeing it as a more proactive way of adding value to an enterprise.
Exactly. And the good news is that, people in companies are becoming aware of it, so that when we go to a company now, more likely to get at least a favorable listen. They may not want to make any changes, but at least they're willing to listen to you, and that's a big improvement.
And now, obviously, the kind of countries and companies we're talking about here would be at the relatively higher end of some kind of risk spectrum. What would you say to somebody in terms of asset allocation across their portfolio? What kind of percentage do you think they should put into things like frontier and emerging markets?
Well, if you look at the GDP of the world, you'll see that now emerging markets, including China, India, Russia, Brazil, etc., represents almost 50% of the GDP of the world. And the market capitalization, depending on which numbers you look at, are maybe 30, 35% of the market capitalization of the world. So if you know that, and if you know that emerging markets generally are growing faster than the developed countries, then you should have at least 30% of your portfolio in emerging markets. And I might emphasize it should be emerging market equities. I believe for the individual investor, equities are the way to go.
Okay. And we touched earlier on about currencies. Now, I just sometimes wonder, people perhaps forget that back in the late 70s, America had to issue treasuries denominated in Swiss francs because nobody wanted dollars. Yeah. And I wonder, with all the kind of stuff the Fed's up to at the moment, is the mighty dollar potentially going to go out of favor again, do you think?
Oh, yeah, there's no question that the dollar will decline as the renminbi and other currencies come up. But I think one of the things that we must all remember is that no currency holds its value. No currency. If you look at the history of currencies around the world from the beginning of mankind, nothing holds its value except gold. So knowing that, you've got to be in equities because the companies adjust their prices according to the devaluation of the currency. And of course, the US dollar has been devaluing as well. They call it inflation, but it's not really inflation. It's a devaluation of the currency. So we are facing that, of course, in emerging market countries. And a lot of people are afraid of a devaluation, let's say, of the Brazilian real or the Turkish lira and so forth. But what we do is we look at the currency and say, look, do we expect this currency to devalue or revalue? If we expect a devaluation, then we look at companies who will benefit from the devaluation. So obviously exporters will benefit because their costs are in local currency and they're earning dollars or Swiss francs or whatever they're exporting in. So currency can be your friend as well as your enemy.
Yeah, indeed. Although I think the next big trend seems to be potentially towards perhaps a digital currency, and some people, rumors of having perhaps a gold-backed digital currency. I mean, would you see any interesting development in that area? Or I suppose you should bring cryptocurrencies into that discussion as well.
Well, it's already happening. Cyber currencies are big. Nobody knows how big Bitcoin and other cyber currencies are. We do know, if you know about the dark web, you know that there are an incredible number of transactions taking place in legal and illegal avenues. And you're talking billions and billions of dollars in these transactions. So that's another reason why I tell people, the value of currencies is what you believe it is. It's there's no intrinsic value. Now, if they create a Bitcoin or a cyber currency backed by gold, that could be very, very interesting. That could become a real international currency. But the problem in doing that, you have to have one central location where that gold is going to be held, and you got to trust the people that are watching that.
Indeed, yes. And of course, Mr. Nixon said he was only temporarily taking the dollar off the gold standard in 1971, didn't he?
That's right.
I can't let somebody like you go, Mark, without at least having a little bit of a chat about your amazing career. And of course, you work very closely with another investing legend, Sir John Templeton. What was it like working with him, and what were some of the key lessons that you learned, by working alongside someone like that?
Well, he was an incredible inspiration because he was a true value investor. He was a long-term investor. He taught us a number of things. One, patience. He said, look, you've got to be patient. Number two, you've got to constantly be learning. You've got to keep an open mind and constantly be learning. In fact, it was funny because we would visit him in Life at Key in the Bahamas where he lived. And at lunchtime, every time he would go to the beach and walk in the water while reading his reports. And somebody would ask, hey, where's John Templeton? Of course, he was considered investment gods at that time. Someone said, yes, he's walking on the water, reading his reports. So he was a real inspiration. He was very, very humble, very open-minded. And he said, look, the most expensive words in the world are, this time it's different. And I think that was very wise saying. He also said something that was very significant. He said, to buy when others are despondently selling, and to sell when others are greedily buying requires the greatest fortitude, but pays the highest rewards. And that's really what it's all about. You've got to be patient. You've got to wait for these opportunities, like we've seen with this COVID, and be buying when others are despondently selling.
Indeed, yes, and so it must have been fantastic to work alongside him. But then you now, I guess, find yourself in the position of being a mentor to your team. So as well as wisdom you learned from him, what are you passing on to them?
Well, it's really interesting because we have a lot of interns in a company who come to learn, and I frankly learn more from them than they learn from me, because you've got a generation of people, of young people, who've had the incredible access to information with the internet, and their capability and technology is just amazing. So I'm constantly asking them questions and what they're learning and what they're thinking and so forth, because this is the future. This is where we've got to look. We've got to understand this new consumer.
Yeah, indeed. Interesting. I know in your own life, you were born in America with a German father and I think a Puerto Rican mother. Now you've renounced your American citizenship and taken your father's German citizenship. Why was that?
Well, I was living outside of America for at least 20 years. By the time I discovered that, hey, I'm paying taxes in America. At that time, I was in Hong Kong. I'm paying taxes in Hong Kong. No tax treaty. So, I mean, the tax bill was enormous. So I said, it doesn't make sense for me to be doing that. As you know, Americans living abroad must pay American taxes wherever they are. It's very unlike, I think there's probably no other country that does that, that charges their citizens when they're living somewhere else. So it was imperative for me to give up the US citizenship.
I think the only other superpower that does that is Eritrea, but not such an obvious choice. But also, you're an inspiration.
I was lucky because I was able to get my German citizenship because I was born before my father became an American citizen. So that enabled me to get German citizenship.
Okay, cool. But also, I think what inspires me is not just your track record, but when you retired from Templeton at the age of 81, most people would have gone to the golf course or the beach, but you thought, no, I'll set my own company up. So
yes.
You're still traveling the world. So what was it that made you decide that you weren't going to have any of this retirement business?
Well, actually, it was not only me; it was my partners, Carlos Hardenberg and Greg Cognetti, who said, "Look, we've been working together for at that time 30 years. Let's start our own partnership," which is what we've done. So it was not only my idea, but also theirs, particularly Carlos's.
And how's it going? Are you enjoying the freedom of running your own show after all those years in a much bigger organization like Templeton?
Well, I found that when you start your own company, you're not free. Because when you're at Franklin Templeton, a big organization, everything is done for you. You don't have to worry about the custodians, the settlement, the trading, this and that. But now, when you have your own company, you have to worry about all these things. So you've got to read the insurance contracts. You've got to find out whether the custodian is doing a good job, et cetera, et cetera. So I'm more busy than ever.
Fantastic. So what's next for you? What's left on your kind of bucket list of things you want to achieve?
Well, I would like to, of course, grow the company, grow the partnership, and bring in more people because a lot of great analysts around the world that we'd like to bring in eventually as the assets grow. And also, my dream is to have start a prize for love, because I think what's missing in this world is love, in the sense of people being able to give up for other people, if you know what I mean. I think that's something that I would like to do eventually.
Tell me more about that. How would you see that manifesting itself? What kind of format would that take?
Well, it'd be in the form of like a Nobel Prize of this, maybe not as big as a Nobel Prize, but something of that nature. But it's a very difficult thing to define, actually. And I'm racking my brain with some other people to discover how would you define love? Who would you give such a prize to, or prizes to? How would you delineate the boundaries? So love means many, many things to many people, but I think it would have to be defined as a sort of a selfless love. But I think something like that is very important in the world today.
Absolutely, and I think obviously you've got the background and the experience to make that happen. So we'll wish you every success with that. As we come to the end of our time together, Mark, this is a terribly confusing time for investors. We've talked about market manipulation. We've talked about all the uncertainties in the world. Is there any from your decades of experience? You've kind of seen it all. What would you be saying to investors as your kind of golden nuggets of advice for where we should go over the rest of the 2020s?
I think people have got to remember that we are in probably the most incredible era of mankind. We are in an amazing era with improving technology, with improving lives, with better standards of living. Of course, big differences, big problems, but the reality is we are in a much better shape than we've ever been in the history of mankind. So people have got to keep that in mind. And that means you've got to be optimistic. You've got to realize that things are getting better as we go. And if we all push together towards that improvement, we're going to be in very, very good shape going forward.
Some really inspirational thoughts to end on there, Mark. Thanks very much for joining us today.
Thank you very much.